Hey, it's Trader Tim from EminiMind, and in this video we're going to talk about why halfway back trades, also called 50% retracement trades, work. And really it has to do with the human psychology and what the trade is doing, what the market is doing at the time it comes to that 50% retracement. So we're going to touch on that. I want to run through a couple of trades from last week. Today's Monday, so we'll also do some market analysis to look at the week ahead. We have a Fed meeting next week, so I'll talk about how I'm going to plan for that as well. So let's start with the fib retracements, or the halfway backs, 50% retracements. They're all kind of interchangeable terms, but what's happening when the market is coming into a retracement? Meaning, okay, by definition, the market's retracing or pulling back. So if we look at the ES here, the daily chart, we can draw up a retracement, just meaning we've got the low and high anchored with the fib tool, and the 50% is just this yellow line here. Well, when the market is coming down into that fib retracement, I'm looking to go long. So the first thing is the market's going down. I'm looking to go long, doing the opposite of what the current market trend is. But the key is that the larger trend, the larger the drawing that we're anchored to is actually in an uptrend. So if I have my low to high anchored here, I'm identifying that the market is in an uptrend, and I'm looking to buy when the market pulls back from that uptrend. So low to high, the trend is up, and I'm looking to get long on this short-term pullback. And then the second thing it it makes it um, it makes it hard for a lot of people to pull off this kind of trade when really it's an easy concept, is that when the market is coming into that 50% retracement, the candle, the daily candle, is typically always going to be bearish. Like at the time that the market's coming down to a 50% retracement, the candle on the day is bearish. Sometimes we'll get hammers. So a good example, like yeah, we just take this candle here. This red candle here ends up with a rally towards the end of the day, and it closes still bearish on the day, but look at how small the body of the candle is, and the tail is very long to the downside. That forms this hammer. So intraday, this is a big red candle. You've got to open near the high, and at the low point, it's just a big red, scary-looking bar. Who wants to buy that? Who wants to buy the big, scary red bar? Well, knowing that there's a 50% retracement there, you're doing just that. It's the Warren Buffett philosophy. It's doing the opposite philosophy. When the market is down, coming into a 50% retracement, that is the time to buy, because by the time the market is doing what it's doing right now and rallying, you're already in from a much lower price. And let the other people chase the market. You know let the other players do the pushing of the market up, but you want to be in before that trend is so clear. So just the fact that the market is trending short term down with a big red bar at the time of entry is enough to scare a lot of people out. And so the smart money and the seasoned traders know this, and that's why very few traders make up a large chunk of the profits that are coming out of the market. And so if you can just get over that fear and draw up some retracements, just doing on the daily chart before you even go to the intraday, the smaller time frames, to kind of get a feel for it, you can do very well by just getting in at the 50 and then setting your targets at the negative 23% retracement. One medium, if you will, that works really well for doing this is options. Because think about it, if you were going to be buying calls to go long, well, what is the market doing when you're buying those calls? It's going down. So your call options are going down in price as you're looking to buy them. that's great because now that you own those calls at the, here I'll go to the SPY to put some real numbers to it. Let's say you're buying calls here at 387 on the SPY. The market has gone down. Those call options are cheaper than when they were up here at 399. And then when the market rallies and those call options go up and you're selling them, you're closing them out at say, 405, 406 up at this negative 23, you're taking profit into strength. And that works really well. So call option or options in general, just directional, is really good to use for trading halfway backs and retracements. Just doing the straight up futures trades are, that's what I do a lot of. I do some calls and puts, but a lot of the intraday stuff is all based on the futures, the ES. So just something to think about if you've traded fib tool before, use the fib tool to trade retracements. You're always going to have kind of that fear at the 50% because it's not looking like a big green breakout day. It's easy to say, oh, look at the market today, it's all green, I should get in. Well, what have we done from highs of the day? We got 25 minutes left. We've sold off. And so there's been profit taking and we've retraced. And so had you been buying into the high of the day because the market's all green, well, you'd be underwater. And then the market pulls back, you lose money, you get out, and then the cycle starts all over again. So you want to break that cycle and always be looking to kind of do the opposite as much as you can. And so let's run through. So a trade from last Thursday. I'll go to a smaller time frame. That was Thursday was the 19th, and one of the along from Thursday was down near lows. And there's a couple of things intraday that I use to give me a little bit of a leg up. One of those is the NYSE tick. If you're trading the ES, the NYSE tick is a really, really good tool to use because it helps you get a sense of some of the short-term momentum. And so we had come down to this 50% retracement. I guess I should go out a little bit so you can see that 50%. We were just looking at the daily chart. This is the intraday time frame. I'll go back to the daily so you can see it. It was right here, 39.11.88. That was the 50% on the daily. And so we know that's a potential big support level. And so coming down intraday, if you are just looking to buy when the market is going down and you don't have any sort of bigger retracement or support level below you or identified, you could just end up looking to the left on the chart here and say, oh, well, we're lower than this swing low, I'm going to buy. And, well, what does the market do? It kept going down. Oh, here we're down near this swing low, I'm just going to buy. Well, the market keeps going down. So it's important to wait for the market to come down and get a low tick on the NYSE tick at that same time when you're trying to kind of go temporarily counter trend like this. And then wait for us to break the swing high and then draw up your retracement intraday and then use that as your 50%, so 39.16 and a quarter. I like to round up 39.1650 to place my limit order, and then you're catching that run. So that was a trade from Thursday, and then let's see here. Going to briefly I wanted to mention the VIX because we've really had a hard time getting any kind of momentum to the upside on the VIX. Here's an instance of at the time intraday, this candle, this inverted hammer was a big green bar, and then we retreated towards the close and ended up more bearish with the inverted hammer. And then today and yesterday or Friday, the market, the VIX has gone down. So volatility is staying pretty low. That's when the VIX is low, that's a sign that the market, there's not a lot of fear in the markets, which doesn't seem to correlate with what's going on in the economy right now. But, we want to be trading what we see. Trade the market, trade the chart, and kind of ignore what's going on in the news. That can be really difficult to do, but if you want to be a proficient intraday trader, a day trader, you really need to learn to do that. Today we did have a 15-minute breakout off the open. We came one tick away from filling the gap actually, but we did not fill the gap. And so just going long above the high of that first 15-minute bar today had a nice rip, and really up until an hour or so ago, we started selling off. So nice rip. You can use that fixed target of 20 points, or you can just trail each candle. But either way, catching a nice rip. I've had some people doing this on stocks as well. I only do this on the ES, that 15-minute breakout. But if you're just trading stocks, you can make a few tweaks and use that same strategy. But the important thing with trading is that there's so many players in the game. You need to find some kind of edge or advantage. And a lot of times, if you're looking at a chart and you say, oh, wow, this trend, let's go to this morning, for example. Let's say we're here in the day and you say, gosh, we are definitely in an uptrend today. Well, it's probably too late to get long at that point. You need to be getting in your trades when it's back here and the market is, okay, well, we had this, 15-minute bar and we did end up turning it into a hammer. So there might be some momentum. Let's get long. It's early in the day, and we'll see what happens. That kind of, or even like here on Thursday, the retracement trade. At the time of entry, this is what it looks like. The market is coming down into your price. The market's going down, and you're getting long. And so that's not always the easiest thing to do, but with this style of trading, you're placing a limit order, so your order is there at 39.1650, right after I draw up this retracement like this. I put my order out there, and then I kind of sit back. And so, yes, the market's coming down, and it might seem scary to you or to, when you're sitting there with an order, but that's what it takes to get in at such an optimal price and be in when the market starts to rip like that. And so that's what gets you those big runners and keeps your risk really small. You can get away with a 2-point stop. I know some people will just use the 61.8, put their stop below there. But even just an arbitrary 2-point stop on the ES, when you're getting in at the 50% retracement like that, you can get away with a super tight stop because you're getting in at such a lower price with a lot less participants. And then by the time the market starts ripping and all the late to the party Charlies start jumping in, then it starts really accelerating, and that's when you get those knockout home runs. So hope you found that helpful. If you do have questions, feel free to drop them in the comments. If you like these videos, you can go over to EminiMind. I've got a free weekly newsletter, and there's a whole bunch more videos on YouTube here as well. So thanks for watching, and I'll talk to you all soon.